Hey everybody, it's Nico Argyris with OneFin Realty Group, and I had a question earlier this week from a client asking me about supplemental tax bill. So I wanted to put together a quick video just to describe what it's all about. So essentially, the supplemental tax bill that you might receive from your county is a settling up, if you will. And it usually happens after a sale, and they're settling up basically the difference between the old tax rate based on the old value of the property and the new tax rate, which is based on the reassessment of the property after the close of escrow. So to illustrate, let's say we had a property that sold 2 years ago for $500,000. The county reassessed the property, so the owner is paying a tax rate of the assessed value, $500,000, times whatever the tax rate is for that particular area. So let's say it's 1.1%. Then moving forward, let's say 2 years later, the home sells again, and the buyer buys it, closes it, let's say mid-year in June. They pay a prorated amount of property tax, but that's based on the old amount. So what will happen is, after the close of escrow, the county will reassess the property. Let's say the new assessed value is $600,000. So now the tax rate moving forward is going to be based on a factor of 1.1 times 600. So there needs to be a settling up of the differential, if you will. So the county will send the new buyer a supplemental bill, which basically is taking into account the difference between the old assessed value and the new assessed value. So this is going to be paid in addition to your normal tax bill. So the answer is, if you see a supplemental tax bill as a new buyer, please pay it and make sure it's paid on time, because it has the same effect as your normal tax bill will in regards to being a lien. So I hope that was helpful. If you have any additional questions about supplemental taxes or property taxes in general, please let me know. Thanks very much.